Welcome back to the Investing Markets and Money podcast. This week we are talking about Canadian equities, and this time around we have an experienced fund manager joining us all the way from Canada. We're joined by Jordan Zinberg, who is a CEO and president of Bedford Park Capital in Canada, specialist small cap fund manager. And we're going to be talking a little bit more about the dynamics, opportunities, idiosyncrasies of the Canadian market. Welcome to the podcast, Jordan. Thanks for joining us.
Oh, thank you so much for having me, Stuart.
To start off with, can you give listeners a quick rundown on Bedford Park Capital itself and what you do there?
Certainly. Our firm was founded in 2018, and we run a single strategy called the Bedford Park Opportunities Fund. The fund is focused on high-quality, small and mid-cap Canadian equities, and our goal is to identify Canadian growth stocks early in their life cycle and look to capitalize as earnings grow and as valuation multiples expand. The fund's portfolio is relatively concentrated. We usually own about 20 stocks, and we tend to hold positions for long periods of time. However, we do trade actively during those hold periods in hopes of augmenting our overall returns. The fund's performance has been very strong, with a gain of 37% so far this year, following up on a 28% return last year. And our 5-year annualized return is 15%, net of all fees and expenses.
Great, and two things I want to pick out there. One, I mean, 20 is a fairly focused portfolio. If you look at some funds, small cap funds here in the UK, a lot of them are quite diverse. You know, we're talking 40, maybe even 50 names in the portfolio. And secondly, that performance in the Canadian market at the moment is fantastic.
Thank you. So with regard to your first point on portfolio concentration, it's really the style that I'm most comfortable with and I think is a key to our alpha generation. And the reason is that, I don't really want to have capital in my 40th or 45th best idea. And investors who hire us to manage their capital also want more of their capital focused on our best ideas. So I think it's a key driver to our performance. And quite frankly, I think it would be hard to generate the types of returns we had if you told me that I could only restrict my positions to say 3 or 4% each. In terms of the second piece, Canadian markets have lagged US now for a couple of years, particularly the small caps in Canada haven't done well, but we don't really need strong index performance. Our portfolio looks nothing like the index. And in fact, despite weak performance from Canadian small caps last year and so far this year, we've been able to identify some outstanding companies, and we're going to talk about a few of those companies later.
Over here in the UK, a lot of investors actually do have exposure to US stocks, and they're familiar particularly with the large cap stocks and with the US market more generally. Less familiarity with the Canadian market. I know we've got some readers who are invested specifically in mining stocks because there are so many mining opportunities on the Canadian market. But can you give us an overview of the Canadian equity market for those not familiar with it, and also the way that differs from the US market?
Sure. So in Canada, we have about 4,500 public companies, and our main index is called the TSX Composite, which would be our equivalent of the S&P 500. And that index is made up of, I believe, about 225 stocks at the moment. I think one of the key differences you'd see with the Canadian index is that it's quite heavily weighted to just 3 sectors. So about 60 or 65% of the index right now is comprised of financials, energy, and material stocks, whereas the US market would be way more diverse. Another key difference I think you see in Canada is we have several oligopolies in our equity market, including the large Canadian banks, which I'm sure many of your listeners are familiar with, as well as some insurance companies and airlines and railroads, amongst others. So much more concentration sector-wise and some different positioning just in terms of how the companies look. And I think the key here, the key difference is to realize that our markets are much smaller and I think way less efficient as compared to the US markets. And when you look at the top few hundred companies in Canada, I think they're very well covered by the investment banks and they're well known to investors both in Canada and abroad. But once you move beyond those top 200 or 300 companies, I think there are several pockets of inefficiency within the Canadian equity market that astute investors can look to exploit to their advantage. So I think just to summarize in terms of differences, Canada is a much smaller market. There's way fewer eyeballs on our stocks than US equities. There's a lot of sectors in the US market that are not well represented in Canada. So think of technology, think of big consumer products companies, like a Procter and Gamble or J&J. We don't really have a Canadian equivalent of those types of companies. Not a lot of big pharma here, not a lot of biotech here. And then I guess lastly, and where investors will probably find a lot of interest is the fact that our valuation multiples tend to be much lower in Canada, despite having some very high quality companies.
And I wanted to ask you about, I mean, the rationale for a small cap fund. Can you explain a bit about how a small cap manager adds value over and above what, say, a normal long only large cap equity fund manager does?
I think that the best way to answer this question is really in two ways. Let's talk about small caps versus large caps in general, and then I'll speak specifically about the Canadian small cap market and our strategy and how we look to capitalize. So I think the key with small caps in general is that smaller companies tend to grow faster than large caps, and you can typically buy that growth at lower valuation. So you've got higher growth and better valuation. So right there, I mean, I think that's a key that investors need to understand as to why they should own some small caps in their portfolio. And typically, although they're more volatile, small caps, if you can find a good small cap manager, can really augment your overall portfolio returns. And why do those valuation discounts exist? They typically exist because the companies are too small or illiquid for larger pools of capital and ETFs. These companies are often underfollowed by the analyst community. Sometimes they can be thinly traded. So these smaller companies tend to be founder led, which I think gets you better decision making overall and a higher alignment of interest between management and shareholders. So those are some kind of high level differences between small caps and large caps. But in terms of Canada specifically, there's very few domestic managers that are focused on this segment of the market, and barely any non-domestic players that are looking at Canadian small and mid caps. So I think there's just less attention on these names. We've also in Canada seen a thinning of small investment banks over the last several years, which has resulted in even less research coverage than we had before on small caps. And then with our strategy, we're looking at profitable companies, and these are companies that are essentially self-financing. So when you have a self-financing company that doesn't require an investment bank to raise the money, those companies tend to be relatively undercovered from a research perspective and underfollowed. So there's a whole bunch of reasons why small caps will give investors or portfolio managers advantages over simply owning a large cap portfolio. I think you can really improve your overall returns with exposure to high quality small cap companies.
And when you're investing yourself, you mentioned the fact that you can get into some of these stories much earlier in their life cycle. What is it that you look for as a fund manager for a company that makes that magic 20 in your portfolio?
So the cornerstone of everything we do here is based on growth. So I want to buy companies with above average rates of growth. And not only that, I want that growth to be sustainable long term. So I don't want a company that's growing at a high rate one year and then a low rate the next year and then negative growth the next year. What we want is that nice, high, sustainable growth rate. And for me, to put a number on it, I typically want companies that I think can grow at around 20% or more on a sustainable basis. And as you know, Stuart, it's not easy to find companies that will grow at 20% on a consistent basis. And when you do find those companies, oftentimes they have premium valuations associated with them because let's face it, everybody wants to own those types of companies. So what I'm trying to do is look at that group of high growth businesses that give me that high sustainable growth rate, but for one reason or another, they don't have a premium valuation. And there's a number of ways we can find this, but it's often because the companies are, as I mentioned earlier, too small for other players. Maybe they're unknown. Maybe they're not liquid enough for other players, or maybe they're in out of favor or unsexy industries, or they have complex accounting that masks their profitability. I mean, there's a number of reasons why we can find these companies, but when we do find these companies that give us that high growth and that low valuation, and we get in early, that's where we can achieve some outstanding returns over time for shareholders. So we're looking at growth, we're looking at valuation. We're also trying to relate those two numbers together and see if they make sense. And what I mean by that is If a company has very high growth but also a very high valuation, that's probably not something we're looking at. And conversely, if a company simply has a very low valuation but doesn't have the growth we want, we're not interested in that either. We're not just looking for stocks that are cheap. We want stocks that are growing and reasonably priced.
Do you ever look at things like, for example, IPOs, new companies coming on the market, or new private placings?
Absolutely. We look at everything. And in fact, one of the stocks that we're going to talk about in a few minutes was purchased on an IPO here in Canada a couple years ago. But we do look at everything. I think if I were to distill it down, we really have three main plays in our playbook. The first one I like to call compounders. This is just nice high growth companies that will compound their returns on capital year after year after year. And our portfolio is full of companies that look like that. And the second group I would call emerging compounders. And these are companies that have a short track record of giving us the growth we want, but they don't have yet that really long-term performance history. So those would be, to use a sports analogy, those would be kind of like our farm team or minor league team, where we'd have smaller positions in those types of companies. And then the third play in our playbook is simply a special situations play where it can encompass any of the things you just mentioned, including new issues and financings and cleanup trades, fixed income options, anywhere we think we can generate some alpha for our investors.
When you're looking at the market again, what are the sort of telltale signs that tell you to avoid a company? Because I think this is almost as important as the good things to look for, is also those little red flags that tell you, particularly with small caps, don't go near this one.
That's a great question, and as an investor, I think in order to be successful over long periods of time, you really need a framework of analysis, or you need to have a box per se of the things you look for. So to answer your question, if you know what you're looking for, it's also very easy to know what you're not looking for. And I think it would be the opposite of a lot of the things that I mentioned. So a company that's not profitable, we won't invest in unprofitable businesses. We typically like to see the company at least starting to turn a profit. We don't mind being early, but we want to see that companies can be profitable. Even if they are profitable, if we see very low returns on capital, that's something else we typically stay away from. And the reason is that if a company has, let's say, a 3 or 4% return on capital, there's no way that stock's going to perform well over time. There can be some hype around it for a short period of time, but if a company can't compound their capital at a high rate, it's very difficult for the stock to increase at a high rate over time. Another thing I'll watch for is declining margins. Declining margins are usually telling me that either there's an issue within the company or there's competition coming into the company's industry or geography. So that's another thing that we watch closely. High debt levels is another thing that we kind of key in on. I've been doing this long enough and had enough experience with companies that are highly levered to know that that's an area that I don't want to be in. And I think the last thing is low levels of management alignment with shareholders. If I see a company and the management team owns very little stock, that's usually, I'm not going to say a red flag, but it's just not what I want. I want that nice high alignment. And luckily with small caps, as I said, the companies are often founder led, and we have, I'll give you an example. We have one company, it's a $2 billion market cap, and the founder is the largest shareholder and owns 50% of the business. So you can bet that he's going to be making good long-term decisions for the company. Those are some of the things that I would say, well, not necessarily red flags, just things that are not attractive to us based on our framework.
And you've been one of the top performing funds in Canada in 2024. Considerable achievement, especially with such a focused portfolio, as you mentioned. Can you tell us a little bit more about some of the top performing stocks that have helped you to get there?
It would be my pleasure. The first stock I want to talk about is a company called Source Energy, and the ticker is SHLE on the TSX. The stock's been an incredible performer for our fund. The shares were up 216% last year and up another 115% or so far this year. Source is one of Canada's largest providers of frac sand, and it's a stock we've owned since the fall of 2022. At that time, I was sitting in my office and I got a call from a business associate in Western Canada who specializes in energy stocks. And he told me to take a look at Source. And at first glance, I really didn't like what I saw. It was a 30 million market cap company. It had quite a bit of debt, and it was in a sector, oilfield services, that was quite out of favor at the time. But despite all that, I decided to do a bit of work on it. And as I did, the picture of this company started to really change for me. And what I learned was that during COVID, the price of frac sand was very depressed because, let's face it, during COVID, there wasn't a lot of drilling going on. So the company had signed some contracts with their customers, and their customers include Canada's largest energy companies, names that would be familiar to your listeners. They had signed their contracts at very low sand prices, so their earnings were depressed. But by the time I was looking at it, we were already through COVID, coming out the other end, and these COVID era contracts had rolled off, and the company had started to re-sign these contracts with sand prices dramatically higher. So what I started to understand was you had a company that was going to be selling their sand at much higher prices, but there wasn't going to be a big change in their cost structure. So their profits were going to change quite significantly. And then the second piece to the puzzle with respect to the debt was that management was very focused on using their cash flows to pay down the debt and improve their balance sheet. So we started to get excited about the company, started buying stock around $1.60 in the fall of 2022. And the stock got to $6 by the end of last year. So it was a pretty nice gain for us there. But then this year, the stock traded as high as $18 last month. And, it's a very volatile stock. So it went from 2 to 18 and then last month back to 9. And the interesting thing was at $9 versus 18, there was no new information in the market. The stock was just really whippy. So we were trading it actively the whole time. We added some more stock at 9, and I'm happy to say, as I'm looking at my screen right now, the stock's trading right around $13. So it's been an exceptional winner for our fund. And I think a great example of how you can get into a small out of favor company that nobody's really looking at and derive some outstanding returns. And quite frankly, I think there's still a lot of upside left. I see a lot of catalysts for this stock over the next 12 months.
You're listening to the Investing Markets and Money podcast from the Armchair Trader.
So looking at Source Energy, I think there's a number of catalysts that you're going to see over the next 6 to 12 months. The first one is the company's senior notes are coming due next year in March of 2025, and they are actively looking to refinance that debt. And I think they're going to refinance that debt at a significantly lower rate. So they're currently paying a rate of 10.5% interest on their notes, and I think they're going to be able to secure new debt at somewhere probably between 8 and 9% would be my guess. So you're going to see substantial interest cost savings for this company. I've done the math based on that type of interest cost savings. And I think if they are able to achieve that type of interest rate, it's probably worth around $1 a share in the stock price. The second catalyst that we're paying attention to is the expected startup of a big energy project in Canada called LNG Canada that's going to be coming on stream in mid 2025. And the big energy companies are going to need a lot more frac sand. So that project is going to provide increased demand for sand, and I think in turn into the share price. Lastly, the company has talked a lot about looking for ways to grow without using their own balance sheet. And they've talked about things like potential joint ventures with larger players that I think we could see announced sometime over the next 6 to 12 months. And I think just to finish off on Source, despite the really strong financials, the stock is still trading at only 3.5 times earnings. And the reason that's significant is we recently saw a takeout in the space. US private equity firm Apollo bought a US sand business that looks quite similar to Source, and they paid, I believe it was 5.5 times EBITDA. So if we look at the valuation on the recent takeout in the space, it would value Source somewhere in the neighborhood of $30, whereas it's trading around $13 currently. So there's a ton of catalysts coming up on this name.
And that's a good example of a case where, although you only have 20 stocks in the portfolio, it still requires you to manage that individual position as well.
Yes, absolutely. And I mean, this is a bit of an extreme example. It's probably the most volatile stock that we own. But part of the key with small caps, and we didn't really get into this in our early discussion, is execution is actually quite important in our world. And what I mean by that is if you're a large cap manager, you don't really think too much about execution. If you need to sell a big blue chip stock, I mean, they're quite liquid. You can just go in and sell it. But when you're buying and selling small caps, I think there is an additional skill set required. And that skill set is knowing how to source liquidity when you want to buy a stock, and then knowing where to go and how to exit a position or trim a position when you want to. And that's where domestic knowledge and connections become quite valuable because I know the two or three firms that trade Source Energy, for example. So even if you had an investor in another country who was lucky enough to find this stock when I did, I think it would be much more difficult for them to get a position. They would have less access to information, less access to management than I do. So I think, and this isn't specific to Canada, this is anybody who's operating in their home market. I think this home field advantage, to use another sports analogy, is quite important when you get down into the small and mid cap world.
Yeah, no, I agree. I agree wholeheartedly on that. I've seen that in action recently in Indonesian small cap space as well. And what else? What other stocks have done well for you this year so far, Jordan?
Let's talk about another one of my holdings, actually the biggest holding in my fund right now. It's a company called Propel, and the ticker is PRL on the TSX. And this is one that I alluded to earlier that we had bought on an IPO in late 2021. And in Canada, there was actually a flurry of IPOs in late 2021. This was one of the only ones I bought. I was really attracted to this company because quite frankly, it just met all of our criteria right off the bat. It had a very high return on equity. The valuation was quite reasonable. I'm quite comfortable in the sector that Propel operates in, which is non-prime lending. So maybe I'll start by explaining what they do. The company is based here in Toronto. They operate in both Canada and the US, although they primarily serve US customers. And it's an online lending business in which they use technology to quickly and efficiently underwrite small lines of credit that they offer to US and Canadian borrowers. The company is extremely profitable. The stock was up 83% last year, up 95% this year. It's a great example of everything I look for in that you've got that nice high sustainable growth rate. The company's guided towards 30% return on equity for this year. Despite excellent financials and being highly profitable, you can still buy this stock today on 8.5 times forward earnings. So it's been an exceptional winner for our fund. I think the company's still in its early days. It's operating in a very large US market and still only has a loan book that's about $350 million currently. So I think there's a ton of runway. And yeah, it's just a phenomenal Canadian emerging growth stock. Looking ahead for Propel, as I said, they still have a ton of runway in terms of their growth profile, both in the US and in Canada. They've also looked at markets outside of North America. But I think when you look at this company with a very high return on capital and a single digit PE multiple, these are exactly the types of companies that I get excited about. And I have a feeling we're going to own this stock for a very long time.
Looking at the overall market, do you have any sort of bias towards particular sectors? Are there any sectors you favor, or are you relatively sector agnostic when it comes to these picks?
So I would say we're sector agnostic with a few exceptions. Ironically, despite being a Canadian-based investor, I actually don't invest in resource stocks, which some people find quite interesting because Canada is obviously well known for energy and mining stocks. Getting back to skill set, which we talked about before, I think investing in resources requires a bit of a different skill set. I think you have to have a very strong view on the underlying commodity that you're investing in because let's face it, if you're investing in a gold stock and gold isn't doing well, the stock's not going to go up. So I think you need to have that very strong commodity sort of directional view, which I just don't have. So I will buy energy services and mining services stocks. That does give us exposure to those sectors when they're working. But those companies usually resemble more of a traditional industrials type stock. So I think you don't need that commodity type view as much. Aside from resource sectors, though, we are agnostic. We found great companies in lots of different sectors. I would say right now, financials and technology would be the biggest weighting in our fund, but it's not by design. We look across all sectors and we use a bottom-up approach and we let each individual company compete for our attention.
And taking Propel as an example there, obviously a lot of Canadian companies do well in the US market. They have a lot of exposure in the US market, a lot of revenue derived from there. Do you ever take that into consideration? Do you have any sort of geographical bias where you're looking more at company because it's a Canadian focused company in terms of its actual market, its domestic revenue model, or is that less of an issue?
I would say it's less of an issue. I mean, we're really looking at the company as a whole, and a lot of our companies operate outside of Canada. The majority of them do. We do have some that sort of focus exclusively on Canada. I wouldn't say it's a big consideration when we're looking at a company. We're just still looking at the overall business. Obviously, if you get into currencies and things like that, you can have small kind of headwinds or tailwinds on specific quarters if companies are operating in foreign currencies, but their stocks are priced in Canadian. But I mean, really, it's not a substantial thing that I pay attention to.
Lastly, I just wanted to ask you about short selling activity in the Canadian market. Obviously, it's a market you're very close to, and we hear complaints from some quarters about the activity of short sellers in the Canadian market. Do you see them as a problem as well, or what's your take on it?
I don't think problem is a fair word. I think just to set the stage, so in Canada, there are very few domestic funds that are short biased or very short focused. We do have several sizable long short players. And then obviously we see non-Canadian investors come in and short Canadian names all the time. In several instances, I think some non-Canadian players don't take enough time to understand the nuances of our market and the types of names that they're shorting, but that's a story for another day. Over the course of my career, I've seen a number of bear raids and other aggressive short selling campaigns here in Canada, and some have been successful and some have not. Our fund is primarily long. We short opportunistically because of the types of companies we look for and the fact that I'm looking at profitable growing businesses most of the time. I just don't find a ton of good short ideas. I do come across short ideas once in a while if a broker is pitching me something that just looks really terrible, or we spot pockets or bubbles of extreme overvaluation. So a good example of this would be the cannabis boom that we saw here in Canada a few years ago. But despite not being a big focus for our firm, I don't think it's as big a problem as some CEOs make it. I think it's really case by case. Obviously, no CEO wants to see short sellers come into their stock, especially when that comes along with detailed and often damaging research reports that criticize the business and the management team. But do I think short selling should be banned? No, I don't think so. I think investors should be able to express their view on a stock as they see fit, whether it's long or short. As long as short sellers are playing by the rules and they're conducting proper research and they're publishing factual information, I think they can actually provide a very valuable service to other investors and to the market as a whole.
Fantastic, great. Well, thank you very much indeed for your perspective on that, Jordan. And thanks also for coming on the podcast today. I really appreciate you taking the time.
It's my pleasure. Thank you, Stuart.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.